Hello traders, Gary Wagner here, just before 11 o'clock on Friday. Happy Aloha Friday, as we say on the islands. Third day of January 2014, and this is the daily report for gold and silver, our weekend review, and what a first week to 2014 as we see gold and silver both surging to the upside. This is about the best rally we've seen since October of last year. First to gold, we are just under our resistance point. You can see that magenta line here, currently trading at 1236.44. It's had a high of 41. That is the current resistance, a low of 27.40. As far as silver goes, trading above $20 per ounce, up about 14 cents on the day, with 19.97 the low and 20.42 is the high on the day. Traders, we're going to start today's weekend review by taking a look at our 60-minute chart. 60-minute chart is really good or eloquent in terms of giving us current minor levels of resistance as well as support. Of course, with this kind of an upsurge, we're looking at different levels of resistance. First and most noteworthy is the fact that we have seen some real support. Of course, it's hindsight, but we have had this double bottom here at roughly 86 and 88. And that, of course, as you'll see as we go out to different time cycles, matches up with the 1181. Then that's the double bottom I'm talking about. Not these two lows, but these two lows when you compare them to 1181. Now, when you do that, we have created basically three fib retracements, all of them starting just below 1300, 1294, and all of them going to different lows in the market. So this latest low, these figures are right here, and of course we have these figures here for these two lows. Most significant, I believe, are the information that we're going to derive from the longer of the two sequences, and our 50% retracement takes us to a price line of 1240. We did hit some resistance in this area, and when we look at this historically, and that's what I tend to do, it isn't the strongest of all levels, because when we look at the market, how it's peaked above it, here's one area where it was resistance, and here's one area where it was support, but the market does trade through these areas on many occasions, as many as it trades to this area. You can see it going well above that, and here we have it being fairly good in terms of a support area. So the next level of resistance we're looking at right now is approximately 1240. And as I said, when we looked at our previous chart, that was a 60-minute. This is a 4-hour chart. We really had to get a chart that allowed us to have more time involved to see this double bottom that I'm talking about. And this is the 1181. It's quite obvious that this market has absolutely held this level of support, which brings us to the idea of the two different models that we have been looking at. One of them is a truncated fifth wave, or a bear market truncation, and that is a pattern or a model in which you have your waves down on this final fifth wave, and we'll be able to really see that better as we bring up some of the charts that have our current count. And rather than it making a traditional lower low, a lower low than the bottom of wave 3, this being our long wave 3 down, we had our A, our B, and our C. This terminated right here with our wave 4, and this, of course, has been our fifth wave down. On a bear market truncation, in essence, what you are looking at is fairly equal lows, which we've gotten. That's your truncation, so you don't get a lower low on that fifth wave, and from there you signal higher pricing. Now, really, as I talked about yesterday for our daily viewers, and we'll do this with two charts, but primarily it's a longer term chart that I really want to look at. But even if we do it with the shorter term chart, let me put it in as best I can. Really, what we have to see before we can say with any kind of certainty that we've truly broken out of this bear trend, we're back into a bull market, or at least a bull rally within a bear trend, we have to be able to break above these resistance lines that are currently in here. Now, shortest term resistance line, which would be from this high here to this high, we can see that we have, in fact, on today's trading, broken above that. So for our shortest term resistance, we have actually crossed and moved above it. But as I said, this is our longer term, and our longest term resistance line, which we have on our weekly chart. We're close, but we're still $30 or $40 away from a break to that particular point. We'll take a look at that on the next chart, or actually we've got one chart before we go to our weekly. You know, although we pointed out some key resistance that we've run into at around 1240, the significant thing to me on the last couple of days of trading has been that we had a critical level, and this is 1221 to 1227. The 21 comes in because we have some lows right in around here. But the fact that we've been able to trade above that, to me, is absolutely significant. Based upon this particular model and study, our next real level of resistance doesn't come in till about 1250, 1253 is the number that we see on the screen. Now, this is based upon a dramatic decline in which we had, this is right after the market's coming down, right after hitting that 1435. This is that secondary top that we hit last year at about 1365. And from 1365, it comes down and makes that second of two lows. This is the secondary part of that double bottom, of course. The other bottom is behind this chart. We would have to compress it. We'll do that after we take a look at this. But when we look at it from this perspective, you can see the various levels of resistance that we could in fact encounter should this market continue to trade higher next week. Now, we have the majority from my research of professional traders. There's a lot of short positions out there. And the question is, are they going to get squeezed? Because the belief is if they get squeezed, we could see a continuation of higher pricing next week. This all due to the fact that some of the hedge funds that have large short positions on are unwinding those positions. Now, traders, all I've done, I've compressed this 720-minute chart so we can account for, this is that large rally, the single only rally we really had in 2013, takes us up to about 1435. 1430 is the top that I've got here. This is that low that we have been looking at, 1180, and of course, this is the double low. We can see that within this chart because this particular rally that I'm talking about really started on these lows. So that makes these lines fairly significant. As you can see, when we look at this, we don't have any true harmonics. I'm actually able to place these all flush right because none of them are really lining up on top of each other. And what we get then is channels of resistance and channels of support. Our next real channel is going to be, according to this model and study, 1244 to 1253. So the real question that remains, the $64,000 question, is whether or not this particular rally that we're now witnessing is going to unfold really as a truncated bear market or a truncated fifth wave, or whether this is just part of, call it wave 4, and then we will get a final fifth wave down. That's still to be determined. But as we look at this chart, and let's go ahead and kind of blow this up just a little bit so you can see our most current count, and let's kind of line this up and move it over. This is basically what we've been looking at. We have, in terms of our basic model, given us a long wave 3. We have our wave 4 here, and this is easily identified with our ABC. Now we go into our fifth wave down. The question is this fifth wave down, are we going to see this bear market truncation? We absolutely have our first wave, our second wave. I believe that if it is not a truncation, this is probably going to be the beginning of our fourth wave. However, realize this, our fourth wave cannot run into the territory of wave 2. Wave 2's territory is these two black arrows here. So for this to be a valid count, it would have to go up but stop at this point and then move back down. So we're really going to get some important information. Should the market continue to track higher next week, we're going to get some really important information as it comes up to this area being at around 12.50. So roughly, what, $14 from where we are. It's not that far at all. And if we see it stall in this area and move down, it's going to lend credence or support to our model that is looking for a total of 1, 2, 3, 4, fifth wave terminating below the low of 3. However, the other scenario is that bear market truncation. And if we're going to see something like that unfold, we've got 1, 2, 3, and it truncates. We typically would get a 5 count, but that's always not necessary. But we get this double bottom. And if we move, really, as I just said, past this line, which would put it into the territory of this wave 2, that's telling us that the evidence is really pointing towards the distinct possibility that what we've just witnessed is a fifth wave truncation or a bear market truncation. So when we take a look at the big picture, and to do that, I've pulled up our weekly chart. This, is, of course, is a continuous contract of COMEX gold. When we take a look at this most recent fall, there's absolutely no doubt. Any way we want to look at it, we have some sort of a double bottom right here. We absolutely do. And the question has got to be, in terms of our large count, we have our large wave 3, our wave 4. Have we terminated wave 5, or will wave 5 give us a new low? That's something, as I just talked about, we really need a little bit more evidence. The key is that we have bounced radically and in a very, very strong manner off of these lows. Asia is back buying as India has really lightened or loosened some of their import regulations that they had last year. So we've got physical demand growing. At the same time, EFT volumes are actually diminishing and actually lower right now. And so we're getting a lot of mixed signals in terms of the physical market, but in terms of price, we have absolutely bounced off of this price. And as I said, next week we should have all the keys that we need to be able to ascertain which of these two models is unfolding and then act accordingly. Now, silver is following suit. It is trading in tandem with gold, but it's certainly not nearly as active as gold. A Japanese average chart, weekly chart, long character, shows us that we had a tremendous range. When we look at our weekly chart in standard candlestick format, and what that does is it gives us our true opens and closes, what you'll notice is we pretty much have the same doji-like candle. Now, this is a long-legged doji. This is actually called a rickshaw man in terms of the type of doji. It's a fairly rare candle in that you get this extremely long tail. You get the doji towards the upper, call it 1/3 or 2/3 below it, and this is simply called a rickshaw man. But it's an interesting candle because when you consider the low down at 1872 and the high well above $20, I think today's 2042, you've got this significant range all within 1 week. Now, in terms of our levels of support and resistance, we're looking at support still being above 1958. It's traded well above that today. We still have resistance at 2022. And then again at 2116. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.